Welcome to Tax Pooling, Depositing Benefits and Reassessments webinar. I'm going to welcome today's moderator into the conversation. Good morning, Rick Jones. How are you?
Well, thanks, Linda. Thank you for that introduction, and good afternoon to all of you around the country. And it's my pleasure to welcome you to today's sponsored webinar, Tax Pooling, Depositing Benefits and Reassessments, sponsored by Tax Management New Zealand and hosted by us here at CPA Australia. It's great to see a large number of members on the line from around the country. So as many of you know, my name is Rick Jones and I'm the New Zealand Country Head for CPA Australia here in New Zealand. And as Linda said, we've got people joining us from across the country. So it's great to have you here with us today. And look, without further ado, I'll now like to introduce you to Kathleen Payne. So Kathleen, I'm going to hand it over to you to get us going.
Thanks very much for the warm introduction, Rick. It's great to be back here with you all. Continuing education series on tax pooling to provide you with tips and tricks on how to get the best outcomes for your clients. Just a little bit about Tax Management New Zealand before we start going into the actual parts of pooling. Basically, that we have been around for 20 years now. We actually celebrated our 20th year anniversary yesterday, which is a great milestone. We were the pioneers of tax pooling and are the largest tax pool intermediary. Last year, we actually hit the $10 billion mark in the pool, so that was quite an achievement and gives you an indication of, you know, if you think about all of the pools, how much is actually being used within the market in New Zealand. Of course, it is New Zealand unique, so something that, you know, people who are dealing with us from offshore have to get their heads around a wee bit. One of the things that we're very proud of our expertise, and that's, you know, one of the reasons why we do these webinars, is to communicate out to you all the tips and tricks of using tax pooling so you can use it more effectively and add value to those transactions that you're doing with your clients. We've got a massive client care team that look after the people that ring in to talk to us or to email, and very proud of what they do. And lastly, just wanted to give a mention to our 100% invested in a thriving Aotearoa. Through our philanthropic partner, the Whakatupi Aotearoa Foundation, all of our profits for the last 2 years and going forward for however long we were here around for are all going through to New Zealand. And what that means is that we're investing and donating a combination of those two things into sustainable climate change and community projects. So that's something that makes it worth getting out of bed for in the morning. And if you're dealing with us, then obviously that's something that you're giving back to as well. So let's move to the learning objectives for today. What we really want to get out of this session is identifying how and when to use tax pooling when a tax reassessment is issued. That's something that we see quite a bit of at the moment, so I think it's quite topical and ties really nicely into the fact that we want you, as an objective of this, identify opportunities to maximise the use of tax pooling through depositing. So those two kind of go hand in hand, which is why we've got them together today. And then the third objective for learning out of this program today will be understanding how to explain to taxpayers the options that they've got to meet their tax obligations. So if we can get to meeting those three objectives, we'll consider it a job done. Let's start with depositing and the benefits of that. So I guess the place to start here is, what is a deposit? And then we can talk more about who might request it and, you know, what are the benefits of it. Effectively, when you're depositing, instead of paying inland revenue, you pay through to the pool. So on a provisional tax date, when you would normally pay IRD, the payments come into the pool. They're normally held in the pool until the tax return is prepared at the end of the year, at which point you then know what the liability is and can transfer funds from the pool to the taxpayer's IRD account. So that sounds quite simple in theory, but you need to know why you would do that. Why do you do that rather than paying IRD? Let's have a look at some of the clients that you might have that would use pooling. So, you know, usually it's for those cash rich or cash flow positive clients. The ones that we've sort of got on here are not exclusive. They are, you know, could be an and or an or. Sometimes they're the same thing together. But those who want the ability and to access the options that they get to deal with their tax and the the ability to actually explore earning interest on any excess tax that they have over and above IRD rates of overpayment interest. Those who are a little more advanced in their tax planning and who actively monitor their tax position would benefit from polling and using depositing. Depositing does come some with extra administration, so that's why we tend to do it for the moderate to high tax liability taxpayers. And that's really just because you need to instruct the pool to transfer tax to IRD when you're doing depositing. They're your funds, you have total control over them. We normally see those with that moderate to high tax liability using the pool, particularly in terms of depositing, particularly because they can have large amounts of monies with wide swings of variance in terms of their tax liability or their cash flow. So they've usually got much more of a focus on managing that rather than the smaller people. That's not to say that smaller taxpayers don't use depositing, they absolutely do. Where we find that they are using it more is where they've got a group of taxpayers that they are using depositing with, and they are doing transfers between those taxpayers at the end of the year, and depositing, by holding that tax in the pool, it allows them to do those transfers. So that's really useful for those types of taxpayers. If we start with what are the benefits of depositing, managing your tax when the position or for tax position, so the liability, or the cash flow position fluctuates is more easily done when you're using depositing. If you pay too much tax, you have additional options to deal with it compared to IRD. These days with auto refund at IRD, you need to correspond with IRD early to make sure that they hold funds in at IRD for you so that you can then deal with them. Otherwise, they're refunded back to you, and we know how annoying that can be because our clients tell us that that's a huge point of frustration for them. So with deposits in a tax pool, if you do have any excess, we have the ability for you to control that within the pool before it even gets to IRD. And because we need an instruction from you before we can transfer those funds to IRD, then it's totally within your control as to when and how much you transfer to IRD. If you have excess deposited own funds, which is what the industry calls them, deposited funds, own funds, you can transfer these to pay other tax types on or after the deposit date, such as GST or FBT. So that's quite handy. And again, we're kind of aligning ourselves with what you can do when it's at IRD, but it's also a benefit of depositing. You don't lose that flexibility that you have when you pay IRD as well. You can actually transfer those funds at the date of deposit rather than the date of request because they're sitting as own funds. So that's a benefit. There are several ways to use excess tax that you have in the pool and earn tax pool interest, which is higher than what IRD will pay you on the overpayment rate. And we'll talk more about those sort of options soon, about those excess funds. If you haven't paid enough, of course, you can use the pool to buy that extra tax. That's not a benefit directly of depositing into the pool, but it just is one of those strategies that you have when you're doing everything together in the pool. It's one of the many tools that you can pull upon. And you can have access to tax deposited in the pool as a line of credit. We commonly call this a drawdown. It's not something that a lot of people know about, and it's not widely used, but it can come in really handy. So let's go through an example of that. Say you've deposited funds at P1 and P2, and then after that you think you have a need for the cash back in the business and kind of regretting that you paid the money over and held it as tax. Well, there's a really simple answer. You can use that as a drawdown. Take that cash that represented tax on the pool out into the business for a temporary period of time and then pay it back into the pool when you've got your cash flow sorted again. What that enables you to do is have a short-term use of those funds as a line of credit up to the maximum of the amount that you've deposited into the pool. You get charged interest, of course, for that because it is a line of credit, but the interest is only calculated between the date that you're drawing the funds out and the date that you're putting them back. What happens with that tax while it's in the pool? We actually get a funder to take it over, and I'm telling you this because it kind of helps you understand the mechanisms. you've now got an option to buy that tax back when you put the money in the pool. So we've held that tax for you. Once you actually pay the money back into the pool, it now becomes purchased funds rather than owned, and you can transfer it over to IRD. We saw that used a reasonable amount during COVID, and every now and again I have someone who says, I just want to retain my dates, I really need that tax, but I need the cash more, and this is one way of helping those particular taxpayers. So something to remember and talk to us about if you think that would benefit you or your clients. I think one of the other important things to note is that there are no fees for using us. We don't charge you to open an account, we don't charge you to hold the fees in the pool, and we certainly don't charge you for our tax pooling advice. So, don't be afraid to ask us questions, and if you do need help in doing transfers or swaps, of course we can direct you how to do those on the dashboard, but you can actually ask us to do that, and again, there are no charges for that. What you will see us charging you for is interest, and sometimes that interest is actually called a fee just to confuse you when it's related to a tax finance, and that's because it's an accounting term. But otherwise, it's a free service that we're offering here. Let's talk a bit further about managing fluctuating tax positions and cash flow positions. One of the advantages of depositing tax into a tax pool is that if overall you've paid the right amount of tax, but it's not sitting at the right dates within the tax pool date, so your provisional tax dates, then you can swap it in the pool before you transfer it to IRD. I'll go through a slide on that shortly to sort of explain it a bit further, but it's functionality that you don't otherwise get with IRD. As mentioned, you can purchase that underpaid tax, and obviously you will pay less interest than what you will to IRD because our rates are less than use of money interest rates, and often those rates are comparative to other sources of working capital. If you have excess tax, I mentioned before various options for dealing with that. If you're paying us directly instead of inland revenue, the tax does sit in an IRD account under the pool's name, and it's earning therefore IRD rates of interest. If you're all up to play with the interest rates, for 2 years the rate was 0 for overpayments, and so that's what that money was doing in the pool. It was earning 0 interest. From the 29th of August 22, that changed, and we're now back to an IRD overpayment rate of more than 0. So that's helpful that at least if you do have any excess tax, then you can earn interest on that if you decide to take it out of the pool. You can have the tax refunded along with that use of money interest if you get to a point where you say, I've actually done all my transfers, say we're doing the 2022 year, and you don't need that tax for another year or a different taxpayer, you want the money out. We can do that, and you'll get that money out within 3 to 5 working days. There are some AML requirements that I will talk to at the end of this slide. Refunds are perfect when you have an immediate need for cash. And, it's much easier than with IRD. At IRD, you have to file an estimate or the return in order to get that cash out. No such restrictions with us. It's your money. You have control over it. If you have a bit more time and are wanting to maximise some value on that excess tax, then you could consider putting that tax up for sale with us. When we do that, we're looking for a counterparty who wants to buy tax at the same date that you've got it for sale. And if we manage to do all of that and the stars align, that's great, because now you can earn TMNZ interest, or sorry, just tax pooling interest, which is over and above IRD's interest rate. And that again can be, once it's sold, we normally do sales at the end of the month, but that might differ between the pools. Once the pool has actually sold the funds, those funds can then be refunded out as a cash payment to the taxpayer. You can always just transfer excess tax forward to a future tax period or a tax year, just like you do with IRD. There's no disadvantage to doing depositing. You can also, when you sell that tax, decide not to get it refunded. You may say that you have got a deposit coming up or a payment due and want to apply that tax to that future date. That's really handy if you think about where we are now with March balance dates and you're sorting out all of your 2022 tax periods. You might be going, okay, I've got some excess tax like we just talked about with the sale. And what you could do is, so what we talked about before with the sale, we can actually get that money sold and then deposit it for 7th of May. That would be kind of handy if you haven't got cash put aside for that or haven't got sufficient cash put aside for that. You can also consider doing a transfer from the pool to another taxpayer. They need to be part of a group sitting in the database of the tax pool. But what that does is enable you to share tax that's paid in one taxpayer with another associated or related taxpayer. The biggest thing you've got to remember with that is that unless you're transferring it to a group of companies, so maybe so they've got to be 66%, greater than 66% common shareholding. As soon as you do a transfer from one member to another member of a pool group, they become purchased funds. Not sure if you'll remember, but there's a trick to purchase funds. They have to be transferred over to the ID account of that taxpayer within 75 days after their terminal tax date. So it's just a timing issue. It's something that you'll be working through now with taxpayers with the 2022 balance date. And what you'll be thinking is, okay, who in this group can benefit from these funds? I've got a surplus in one taxpayer. I can use that in another one who hasn't paid quite enough. And if you need to do swaps between those taxpayers, that first taxpayer first to get it to the right dates before you transfer it, you do all that now in the pool and then transfer it across when you've got it all sorted. And I'll talk a bit more about what does a finalised tax position look like and what are the tips and tricks to make sure that what you transfer is the right amount. Some of you will know that you can only purchase tax for other tax types if there's a reassessment of the return, and we're going to talk about reassessment soon as well. But you can actually use deposit or own funds for other tax types, and I mentioned that earlier. But it's one of those things you do with excess tax. You can get to the end of a tax year and go, okay, I've got this excess tax, and you can then say, well, I've got an upcoming GST payment. Why don't I apply some of that to that GST payment? So that's something else that you can do with that excess tax. And lastly, you could simply hold that excess tax in the pool for those what-if moments. And this is part of what we call risk management. It used to be done a lot pre-COVID. During COVID, we saw a lot of people actually push funds out into back out into their own pocket because they needed cash in the business. That's just as simple as it was. Whereas what we've seen now is people are starting to think about those what-if moments because they might have had the odd reassessment voluntary disclosure. And so they're thinking about that risk part. Can I just leave the funds in there? It could be that you decide, I'll leave them in there and we might use them for that future tax year once we've seen how that tax year actually rolls out. So that is also helpful. Of course, any tax that's been sold, refunded or drawn down from the pool, i.e. any time that cash is actually leaving the pool, that can't be done without considering AML. AML requirements are that if you are taking out any funds out of the pool over a 12-month period, so the last 12 months, that accumulates to $10,000 or more, then AML needs to be done. But don't worry about it. It's not a stress factor, or it shouldn't be, because the way that we do AML today with automated systems and that makes it really easy, particularly for individuals and for companies, because you're looking at shareholders, even trusts with the trustees. The individual part of it is really, really simple. The tricky part of it is if you do have a trust, it just takes a wee bit more time because often we need a little bit more documentation and we may be talking to more people that we need to do AML on for. One of the other things that can slow AML down is if you've got offshore holdings somewhere and you've got to track that through. I guess the key message I'm saying here is AML is just one of those things we live with in today's world. It shouldn't faze you, but you do need to be prepared to do it if you're going to take funds out of the pool that exceed that $10,000 limit. The other point that I'd like to make here when we're talking about depositing is if you've got a company or business coming out of losses, more so companies. So if we talk about those, they may not have actually paid tax in quite some time. So the rules, that they might have operated with tax in before, in terms of provisional tax rules and use of money interest rules. That may have changed from the RIT divided by 3 rule that they lived in previously. That can be a bit nerve-wracking. It can also be hard to think about what is my actual tax liability going to be because I've been in losses for the last few years. Obviously, standard uplift and staying with that will give you interest protection, and depositing into the pool an amount that you think will be adequate by forecasting your tax liability will help you manage that position. And we've already talked about sort of the benefits and how you can move it around, do swaps, etc. Coming out of losses, this actually gives you just that extra bit of comfort that your position is controlled until you actually land on what your final liability will be. Standard uplift will obviously tell you that P1 and P2 are probably nil and that the tax is due at P3. So it is about making an informed choice about how do I best manage that tax liability. So let's go back to talking about swaps that I mentioned earlier. I talked about it in a position where if you've got within a taxpayer's account tax that's overpaid at one date within that taxpayer's account and underpaid at another date. So you've got overs and unders within the same taxpayer. They don't need to be in the same tax year. They could be that you've got tax, overpaid in 2022 and underpaid in 2023, or vice versa, which is what I'm seeing a few taxpayers do now, in that they've underpaid at 2022, don't have cash to make a purchase for that 2022 liability. So we're doing some swaps from their 23 tax back to their 22 period with a view that later on they'll do a top-up purchase in their 2023 year when they get cash back in the business. So again, we're helping managers with that fluctuation in their cash flow and managing their tax liability. When we do a swap between these two dates, we're actually doing a sale and a purchase, but they're just between these two dates. And the benefit of that is that interest is actually calculated only between those two dates. And I'll show you a slide soon that illustrates that visually a little bit easier, and I usually find that quite helpful in trying to understand what a swap is. Swaps are generally determined, the availability of them is determined by the market that you're in. So when we've got everybody settling up 2022 tax, that's quite a good swap period time to be in, because there's people who are settling up their underpaid tax and there's people that are settling up their overpaid tax. That kind of creates tax availability for the swap market at the same time. So we're looking for a counterparty who's got an opposite position to us. Sometimes if we can't find that, the tax pool themselves might actually, buy some of that tax because they've got demand for that tax with purchases and not as much demand for sales in some instances. There is also within that swaps, when you're selling the tax forward, sometimes you might not be able to sell at the exact date that the funds have originally been deposited at. So say we're selling January tax, and say there's not a lot of demand for January tax because most people have paid on standard uplift, and so there's a real big demand at P3 instead, then we could have it that we would give you use of money interest between P2 and P3, but tax pool interest between P3 and the date that we're selling it at, which could be today. So that's kind of to explain to you why we don't always have the perfect match of dates when we're trying to do things like swaps. But we are always trying to get you the best value that we can out of using the tax pool. Sometimes when you're dealing with groups, I kind of mentioned before that if we are looking to maneuver tax between different parties, different members in a pool group, could be mum, dad, trust company, or could be that group of companies with greater than 66% common shareholding. I've seen scenarios where perhaps an individual has one balance date and a trust has a different balance date. That means that we don't have tax necessarily at the right dates in the party that's actually paid the tax into the pool. What we can do then is consider using swaps to get the tax that's excess in the party that's paid to the dates that the trust needs, and then we'll do transfers from the tax paying account to the trust ID account once those swaps have been done. really clever way of moving the funds around and making sure that we're eliminating penalties and interest back at dates where they've been incurred. When we're looking at a net cost for a swap, if we're buying tax back at a date that's been underpaid, so we've got an overpayment at a later date, then you'll be paying swap interest. If conversely, we have excess tax at a previous date and we're pushing the tax forward, swapping it to a future date, then we will be creating interest earned for that taxpayer with that swap. It depends on the value of that swap compared to a sale and purchase, whether we have actually got a long date between the date that they are doing the swap at, or we're doing it straight after we find out that there is a short and overpayment. So the timing can tell you how much you're going to save or not in doing a swap versus a sale and purchase. So let me show you what that looks like. Here's a typical swap scenario where P2, they've got 100K that is surplus, and P1, they've got a shortfall of 100K. So they can do a swap from P2 back to P1. Effectively, we're talking a sale and purchase, but within a single taxpayer and back to that date. That 100K is swapped back, and I'm just using an illustration here. They're not today's rates because it's an older example, but they could cost them interest of $2,282. If instead we were saying, okay, let's do a sale and purchase, it looks quite different. What we're saying here is we are doing a sale of the P2 excess tax of 100K at today's date. So they will earn sale interest over a longer period. That's the bonus. But when we're looking at the purchase side of that swap and we're doing a sale and purchase instead, we are going from today right back to P1. Now, if we were doing that for a 2022 tax return that we're just finalising now, we've just filed the return, we're doing all of this stuff now, that P1 date is quite a long time ago. If we're talking about a March balance date, we're talking about 28 September 22. I'll say 21. Get my dates mixed up already. So when we're looking at that, it's a long time ago, it's a longer interest period. So and also purchase rates are obviously higher than sale rates. So you can see that here we would end up with a net cost of doing a sale and purchase of $5,500, whereas our swap, because the interest is only calculated between those two dates, would be $2,200. So quite a significant point of difference. And to my point I was trying to make just before, if we're doing this now, it's quite a long way past when they actually had the shortfall. That's why you've got such a big differential. If we were doing this just after P2 had been made and we realise that we've got this overpayment, something changed, then that swap benefit versus sale and purchase would be slightly less. So something to think about. And as I said, we can't, always guarantee we can do a swap. We've got to look at the market and see what we can do for you. But it's a great benefit that you won't get with IRD. Okay, that's all about deposits. But what you'll find is when I start talking about reassess tax, that the whole concept of depositing can help in some situations when you've got reassess tax. Reassess tax is where you've got an original return that was filed. It's been either self-assessed or assessed by IRD. You then either have an error that is disclosed either because somebody's found a mistake, and so we're doing a voluntary disclosure to IRD telling them about the error that's been made, or because you're in the position where IRD have done an audit and they've figured out that there is an error. Obviously, when that happens, they reassess the original position, and that could lead us to an increase in the amount of tax due from what was originally filed. At this point, tax pooling can help. There are some rules around how tax pooling can help with reassessed tax, and I'll go through those. Effectively, you can buy for more than just income tax. So when we're talking about depositing and buying tax, flexi tax and finance, we're talking about income tax. When we talk about reassessments, the rules for that within the legislation allow us to expand the use of tax pooling to other tax types, such as PAYE, RWT, GST, NRWT, ESCT, so lots of different tax types, which what I call sort of the business taxes. What you can't use tax pooling for reassessments for is social type taxes. So if you haven't paid your student loan and that gets reassessed at an amount, or say working for families or KiwiSaver employee contributions. So those sort of things, if they sit outside the PAYE return, they're not covered in terms of that legislation that tells us what we can buy for increased amounts of tax. One of the key features of the reassessments and using tax pooling for that is that you must have filed the original tax return, because tax pooling is all about compliant taxpayers. It's a reward for that, if you like. And so I do have this view that if you have played by the rules, then tax pooling is something extra that you can do. If you haven't done that, then you can't. Quite simple in their point of view. The third point I've got on the slide there is that you can only buy the increased amount of tax. So say we're talking about a GST return and the original return was filed, it was assessed, there was an amount of tax to pay, and the client still hasn't paid that amount of tax, that GST. You can't use tax pooling to go back and fix that up. If a reassessment has occurred and there's now more GST owing, then you can buy that increased amount of tax from the pool. And the real key to using tax pooling for a reassessment is remembering what the timeline is to buy it. We've talked about purchase tax and how there is a 75 days after terminal tax deadline for getting that tax across to IRD. That's a really important feature of using tax pooling. But when we come to reassessments, that timeline is somewhat different. We don't have a terminal tax date for GST periods, for instance, so that's not relative. What we do have is a notice of assessment being issued by IRD. And I call it notice of assessment because they used to be called notice of reassessment. Now we see the odd one called that, but most of them just say notice of assessment, and you've got to know that it's a reassessment. 60 days from the date that's on that notice of reassessment is the key date that you have to have purchased that tax from the pool and sent it across to IRD by. So for us, it's critical that we know what that reassessment date is. If you're buying the tax in the pool, then you need to enter that date for us to be able to measure how soon we have to get that tax across to IRD. And it is a stop dead date. We can't go past that. Once we get past that date, you cannot use any tax on the pool to satisfy that GST, FBT, RWT, PAYE liability, whatever it might be. Using pooling, why do we use it? Well, firstly, IRD normally only give you 30 days from the date of that reassessment to settle up that tax liability, that new liability. But when you use the pool, you get an extra 30 days. So while we talk about 60 days as being a deadline, we're actually saying also that it's an extra 30 days. And what does it do? Well, like all purchase tax from the pool, or even transfer of own funds to the pool, and I'll talk about that a bit further in a minute. If it goes across, it's date stamped with the date it was originally put into the pool. Even if it's purchase tax, it retains that date through its life. When it gets to IRD, they'll look at it and go, yep, that's the date it was due per the reassessment, so I'll now reverse the penalties and interest. Now, of course, I know what you're going to say, there's not always penalties on a reassessment, and that's true. When you do a voluntary disclosure in particular, there are quite often no penalties charged, but there is interest, and using the pool can help reduce that interest cost to less than what IRD would be charging. So, a really good option. One of the other ways to measure and use tax pooling for reassessed tax, particularly if you've got an upcoming voluntary disclosure, or maybe you've got disputed tax where you know it's all coming through but the position has not been finalised yet, is to deposit tax in the pool. And what that does is it can, what we call, stop the clock on that transaction. So we're effectively, at the date that you deposit that tax into the pool, that can stop the interest accruing on the tax that you are buying back at a previous date. So say you've got GST, and I use that because that's the one that most commonly happens with, but even FBT or PAYE, you've got a reassessment that's happening. It might cover more than one period. It could be in the past, it often is. We have this, great benefit of hindsight where we suddenly realise that things have not gone as planned. When that happens, we know that something is going to happen in terms of this reassessment. If we deposit that tax in the pool now, we can hold it there until the position is finalised. Maybe the dispute gets played out. That can take a few years to actually happen. It could be that we're just waiting for IRD to process the reassessment. Sometimes that happens really quickly. I've seen some recently that have taken quite a few months to be completed. Once we get that finalised position, we can do swaps from the date of the deposit or thereabouts, depending if it's a provisional tax date or not, and back to each of the periods that you need the tax at for that increased amount under the reassessment. Hence why it's called stop the clock, because we're now knowing, now that you know about swaps and depositing, we've just taught this, you know that that interest is limited between the deposit date that we're swapping it at, so the date we've got the surplus at, and the date that we are buying it back at with the swap. So that is saving us interest from today's date, the date we did deposit forward. You can do it for future dates as well, of course. We know that interest will be charged on that from the date that the reassessed amount comes into play. So we can help you manage it. If you're unsure what to do, always talk to your tax pooling intermediary. They've been there and done this. You're not the first person that's in this situation. So let them help you as to the best way that we can manage that for you. Of course, if a reassessment has already just been done and you've got the notice period, we're now working against the clock for that 60-day period. You really just want to buy the tax and get it across there because we can't go past that 60-day period. So we do have people who say to us, can I finance that out to June? No, we're limited to that 60-day period. So disclose, to help us get this right for you, make sure you disclose the date of reassessment to the pool so that we can work with you to meet the deadline. Make sure you're checking all of the reassessment notices that you've been issued because they may differ. They may, even if you've given one voluntary disclosure, IRD may process them at different times for different periods, and you need to be aware of those dates because that's when that 60 days kicks in. If a refund has already been issued for a period, then that will determine the purchase date for some of the reassessed tax. And that's really common, for instance, with GST periods where you've filed a return, there was a refund. As a result of the reassessment, the refund has now been reduced to a lesser amount. That is still an increase in tax because now you need to pay back some of that refund, if not all of it. So when you're looking to buy tax to solve this problem of the reassessment, you need to be mindful of what refunds have been issued and at what dates. And before you do a transfer to IRD, one of the key things that we have is that you need to actually know that it's showing as reassessed on IRD's end. We have this common, I guess a bit of a misconception that IRD know that, are talking to the audit team, that the pooling team are talking to the audit team, and that's actually not the case. They're not supposed to talk to each other to divulge what's in the pool. Of course, if you're depositing, and I say of course because I haven't actually told you this bit yet, but if you're depositing, we actually tell IRD what people have deposited into the pool, at what date, and who's deposited it. That's a legal requirement and is done within 5 days after the pool fund has received the funds and processed them. So IRD know about funds that are held in the pool. Sometimes we get in these cases where there's disputes and that, where people will say, look, I don't want IRD to know what I'm doing. Talk to us. There are ways to manage that. Maybe we do a purchase instead, maybe a deposit on provisional tax. Anyway, there's ways that we can manage that, so talk to us about it. But if it's not showing in the MyIR yet, the tax pooling team don't know about it. If we go to transfer funds for the reassessment, it is quite likely that they will disallow that transfer and say there is no liability sitting at this date, so we are not able to actually do that transfer, and they will disallow it, and we'll have to go through a resubmission process once that it finally appears. You might think that we've got plenty of time, but if we're working against that 60-day deadline, we may not have much time to make that resubmission happen. So it might not be a resubmission, so it might just be that we're waiting and pushing IRD to do that reassessment. I have one in play at the moment that did a submission of voluntary disclosure on the 8th of March. They still haven't seen that actually appear in the MyIR. We've got time till the 7th of May to get that through, but currently we're just, sending correspondence, or the client is, because we can't deal with it. The agent is sending correspondence to IRD saying, hurry up, I need to meet my deadline and need a notice of reassessment to be able to know, that I can push this across. I need it to appear in my MyIR. So we've talked about the rules around reassessments, and we've said, we needed to file an original return. But what if you haven't done that? What if you didn't know that there was an obligation to pay tax back at this time, so didn't file a return? Well, there is a solution for that, but again, it comes with certain criteria. So we have this thing called Commissioner's discretion. Effectively, if you can't meet the original requirements that I've got up there for reassessed tax when using a tax pool, you can apply to IRD for their discretion for you to use tax pooling in particular circumstances. And you would normally do this by way of filing a voluntary disclosure, and within that, filing the tax return that's missing, and the same thing, and asking for the Commissioner's discretion to use tax pooling in these circumstances. What are these conditions? Well, you need to tell IRD that there is an issue as soon as you are aware of it, or within what they call a reasonable time period. When does that reasonable time period, or that knowledge of knowing that there's an issue, arise? It doesn't arise when the actual event that causes not to, to come to fruition happens. So the not filing of the return. That is not the timing that they're counting a reasonable time period to start from. The reasonable time period starts from the date that you or the taxpayer have understood or realised that there is an issue at play here. It could be that they talked to someone and was talking about a scenario and they went, oh goodness, I didn't realise that I needed to file a return for that. Maybe you've looked at it as an agent and said, this is what's happened. They should have done a return for that period. At that point, you may not have fully quantified what the liability is. And that's quite common. What IRD have said in this space is, if you know that there's an issue and you've investigated it and found the issue to be real, because sometimes we get told stuff, we think there's a problem, and we investigate and we find out actually it's not a problem. It was actually done correctly and somebody had just misinterpreted something. That is not an issue that you need to report to IRD, and you won't be in this reasonable time period and you'll be fine. It's when you've actually done the investigation, figured out that there's a problem, and quantified the first part of that problem. You may not know that it's a recurring issue, that it's happened in previous periods. You might only know that it's happened in this particular period. This is at the point that you tell IRD. And you might say to them, look, we've investigated it. We don't know how big it is. We just know that it's a period now. We're telling you now we want to use Commissioner's discretion. We're giving you the heads up. Please allow us to do that, and we'll go about quantifying the rest of it. We have asked IRD for guidance around reasonable period, and their initial things they said 4 weeks was fine, 4 months was probably a bit long. Haven't heard any more about where they've landed on that, but something that we need to follow up with them and just figure out what it is. The sooner the better is really the messaging that they gave. There are 2 carve-outs to IRD saying absolutely not, you cannot use Commissioner's discretion. The first of these is that you can't intentionally not file the relevant tax return just so that you can ask for Commissioner's discretion, so use this particular section of the Act. The other is that your taxpayer has to have taken reasonable care to meet their tax obligations. And I've seen this at play with a client who actually had shortfall penalties for a couple of their periods for GST. IRD said no Commissioner's discretion on those periods, but you can use it for the subsequent periods where they didn't charge shortfall penalties because they took reasonable care in those periods. So that can be quite unique and just to the taxpayer themselves and the circumstances they find themselves in. But again, it comes back to they are rewarding compliant taxpayers with an ability to use tax pooling. So something to think about there. Look at your client's behaviour before you go and ask Commissioner's discretion. And just a reminder on those tax types that we can use tax pooling for reassessments. I'll just read them literally out now out of the Act. ESCT, FBT, further income tax, GST, imputation penalty tax, income tax, NRWT, PAYE, RSCT and RWT. And a lot of those talk about the rules within those. So the RWT rules, the PAYE rules. So there are, you know, RWT also covers like DWT because it's within the RWT rules. So just have a look at that if you are looking to get discretion on there. We've had some very successful cases that, you know, we've seen where people have applied for it. We're obviously at the end of it, but sometimes we're involved right from the start. The other thing that I'd probably mention within this bit is that, you know, talking to us sooner rather than later to help you get across the line on this is key. You're still working within that 60-day deadline. So even if you're applying for Commissioner's discretion, you know, let us know. We can give you the provisions of the Act that actually apply here so that you can frame up your voluntary disclosure in reference to those sections of the Act. The other thing is that this used to only apply Commissioner's discretion to RWT and income tax, but IRD did widen that. And that was great because they now have included all those other taxes that I've just mentioned that you can use tax pooling for reassessed tax. So that's reassessments. I wanted to just touch on briefly the options to buy tax. And you know, you will have had this in previous presentations with tax pools where we're talking about things like flexi-tax finance, because if you are talking about a reassessment, you might just be going to buy the tax because a reassessment's been issued. I'm working to that 60-day deadline and I might use probably something like flexi-tax to buy that tax. Because you can't finance it over there longer than 60 days, it makes more sense to just go and buy the tax now and pay the interest and tax together to make sure you're meeting that deadline. By now, if we think about all the ways that we're using tax pooling, I wanted to talk about the risks of using tax pooling. Because, you know, people often ask if there must be a downside. And effectively, here's some ways that we're going to look at that. They're really hints and tips to make sure that you're getting the best value out of tax pooling, and most of it comes down to people just not understanding the rules properly. Firstly, determine what funds you have in the pool. Are they own funds or are they purchased funds? So did you deposit them or did you buy them? Buying them is also the result of doing a swap or a transfer from one taxpayer to the other outside of a group of companies. All of those result in purchase funds, and you need to be following that 75th day deadline or 60 days for a reassessment that we've just been through. In a group, know the ownership, know who's in the group. If you're talking about the group of companies of 66 greater than 66% common shareholding, know who was in the group at the time a deposit was made. That's important information when you're talking about doing transfers between group members. Otherwise, you're working, safest way is always to work to that 75th day deadline for all members of the group, and then you won't get it wrong. Trying to do a transfer after that date, particularly between things like trusts and companies, won't help you. Often I say when setting up a tax pool group, if you're doing it between a group of companies, you know, you have one nominated party. I always say the guide is make it the party that's paying the most amount of tax. I try not to use a trust as a pool group parent, if you like. Usually it's either a single taxpayer or a company, particularly if you've got a group of companies. Always provide the MyIR transaction details to your pool. It's a big please, 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 because one, we need to see the position that's going on, and sometimes people make assumptions, particularly if they're working off the tax return. The tax return will often say that all of the tax is due at terminal tax date, and that is simply not true in a lot of cases. The MyIR also kind of supports that position sometimes, because you might get the MyIR and it will say at P3 that tax is split as a due date between, say, 7th of May and the terminal tax date of, and currently 11th of April for 2022 tax. That is not true if the amount of RIT for the year, the residual income tax, is greater than 60,000. The taxpayer will be charged use of money interest from P3. So all of that tax that is split as being shown at terminal tax and P3 is in fact due at P3 if you want to save your client use of money interest. They've split it for the point of indicating when penalties will be charged, but you need to be focused on when use of money interest will be charged. The other thing is estimates. Time and time again, I get people telling me that nobody's filed an estimate. But I implore you to go and look in the provisional part of my IR and see whether that's actually true. We had one recently where there was 000 for all of the provisional tax dates, and the agent went, that's not wrong, but we haven't filed an estimate. Turned out the client had accidentally ticked that on the ID website, and so an estimate was now filed, and we're back to RIT divided by 3. So do have a look at the information that you hold. Don't make assumptions about whether an estimate's been filed. Always, buy back at P3 if your RIT is greater than 60,000. Look at all dates and all reassessment notices. I've mentioned that. And the other thing is checking that all your prior year filing requirements are met before you do your transfers. It is much easier to work with a finalised tax position for your clients than working with one that has not been finalised. If you go to transfer tax, again, we're talking about compliant taxpayers. If we go to transfer tax for the 2022 year and the 2021 tax return has not yet been filed, IRD will disallow the transfer because you haven't met the filing requirements for tax years where a due date has passed for filing that return. So just some important notes to make in here that hopefully will help you get the best out of tax pooling. And of course, now we're just at the end here. I'm just going to do a quick wrap up before we go to Q&A. The learning objectives. I'm really hoping that this has benefited you. You've spent an hour nearly here with me. Identify how and when to use tax pooling for a reassessment. I think we've done that good justice today. Knowing the benefits and how to maximise the use of tax pooling when we're depositing. And then understanding how to explain to your clients which options within tax pooling, so purchasing or depositing, will actually help your client meet their tax liability. So I'm hoping that you're all pretty happy with where you've landed, but I'll soon find out by the amount of questions that come through. I'm just going to pass back now to Rick to let me know about any questions that have come through.
Thanks very much, Kathleen, for that. That's really insightful. So look, we've got about 8 minutes left, everyone, on the call. So look, I encourage you to type some questions into the chat function on the right-hand side of your screen, and then I can relay those back to Kathleen. So I'll just give everyone a couple of seconds to type in a question you might have. But look, I might get the ball rolling, Kathleen.
Yeah, sure.
Does Inland Revenue know I've paid my tax to a pool instead of them?
Yeah, there's 2 ways that they know. And it raises what we call a tax pooling flag. So that's a really good question. I think I mentioned before about deposits. So once somebody deposits, we have to upload schedules to IRD telling them who's deposited, what dates, how much. If they purchase tax, we don't tell them all that information, but we do tell them that this person has used tax pooling. So that puts on what we call the tax pooling flag. And theoretically, and I say theoretically, that means that no debt collection processes happen. You'll see interest and use of money, interest and late payment penalties still appearing on a MyIR, but collection processes won't occur because that tax flag is there. Just a note though, that tax flag only counts for that current year. It's not a rolling thing. So the next year, unless you use tax pooling again, that flag will have come off. So they won't have an indicator you're using tax pooling until you use it the next time.
Great, thank you. And look, I'll ask one more while I've got the floor, while I allow time for others to type some questions.
Sure.
If Inland Revenue know that I've deposited with a tax pool, why do they still charge me interest and late payment penalties?
It's a real source of frustration, particularly for your clients that you're trying to get off, get across the line with tax pooling. And you've said to them, look, I've got it all under control, but they're getting the MyR statements that show penalties and use of money interest, and so it's quite a hard thing to sort of talk to them about. But really you can just say, look, it's all in hand. Here's the statements from your tax pool. It shows that I've got your tax here and that you've paid money into it. You'll just have to be patient and trust me. Once we transfer that tax from the pool across to IRD, those penalties and interest, provided we've got everything at the right date, which you as the agent, of course, will get right with our help, then that interest and penalties will be reversed and everything will be back as it should be.
Great, thank you. So look, I can't see any questions coming through, Linda. I'm not sure if you can see any there. That obviously means that because there's a large number of people on the call, that Kathleen, you've covered all the topics to the fullest extent. So I'll just give another couple of seconds. Otherwise, we may be giving people 3 or 4 minutes back in their day. No questions there. No, look, there don't seem to be any that have come through, but there might be there's some that come through post-event. So look, what I'll do, certainly thank you on behalf of our members, Kathleen, for taking your time to speak. Linda just put in there a feedback link that people can fill out. But thank you for taking the time. It's obviously a judging by the number of people on the call, certainly a very popular topic, and there's lots more to learn in this space. So thank you for your time today, and I'm now going to pass back to Linda to close off the session.
Thanks, Rick.
Thank you, and I will also just echo that and say a big thank you to both Kathleen and Rick for a fantastic webinar. Big thank you to everyone as well for your participation as well as for your attendance today. Now we'll keep the chat box open. If there are any last minute questions, please go ahead and pop it into the chat box now. However, if you are ready to leave us now, that does formally conclude today's webinar, everyone. To exit, you can go ahead and click on the cross on the bottom panel. Upon exiting, you will be automatically redirected to a feedback form. Alternatively, I've also just popped it into the chat box for you as well. The feedback form only takes about 30 seconds to complete. However, it's really beneficial for CPA Australia as well as our panel, so please leave us your thoughts. Having a look at the chat box, just a couple of thank yous there. So thank you once again there, Kathleen. What I might do is I'll pop on the music as you all exit. Hope to see you all in another CPA Australia live webinar. Thanks, everyone.
Thank you.